good afternoon to all of you, my dear students. First of all, I would like to congratulate you all for joining our team, for joining Jaipur campus this prestigious university. And after becoming part of it, you will feel very good. So, I am Dr. Rajesh Kumar Singh from School of Business and Management, Jaipur National University, Jaipur. And today we will talk about generally accepted accounting principles. As we are the students of accounting or commerce, we know accounting is concerned with the recording, classifying, and summarizing of financial transactions and events and interpreting the results thereof. This accounting aims at providing information about the financial performance of any organization to its various users such as owners, managers, bankers, customers, etc. For making the accounting information meaningful to its internal and external users, it is important that such information is reliable as well as comparable. This becomes possible only if the information provided by financial statements is based on consistent accounting policies, principles, practices, etc. In order to maintain uniformity and consistency in accounting information, certain rules and principles have been developed from time to time, which we call generally accepted accounting principles. These rules are called by different names such as principles, concepts, conventions, postulates, assumptions, or modifying principles. Thus, generally accepted accounting principles refer to rules or guidelines adopted for recording and reporting of business transactions in order to bring uniformity in the preparation and presentation of financial statements. These principles are also referred to as concepts and conventions. The term concept refers to necessary assumptions or ideas which are fundamental to accounting practice, and the term conventions connotes customs or traditions, means what our earlier have been doing in accounting profession. We will perform accounting functions in that way based on our traditions. Next is generally accepted accounting principles have evolved over a long period of time. It has not come into existence in one day, but instead it has taken a long time to come to this stage. There have been so many changes from time to time in becoming accounting as a science. So here we can say these accounting principles keep on changing according to the situation, according to the need. As and when need arises, the principles, we change the accounting methods, we change the accounting procedures. The principles of accounting are constantly influenced by changes in legal, social, and economic environment, as well as the needs of users. Therefore, various terms such as principles, postulates, conventions, modifying principles, assumptions, etc. have been used interchangeably and are referred to as basic accounting concepts. So we can conclude that accounting principles are nothing but basic concepts of accounting on which the premises of accounting is based on which the building of accounting had been erected. There are so many concepts from time to time, but generally at this time, some important concepts include: number one, business entity concept. This concept says that entity of the business will be totally different from its owners. The entity of the owner will be considered different from the entity of the business. Business transactions will be recorded in the books of business, not in the books of owner. So, personal transactions of the owner, like drawings, like personal expenses, like personal medical health expenses, like other incomes other than business incomes, are not recorded in the account books of the business. Keeping in view When a person brings in some money as capital into business in accounting records, it is treated as liability of the business to the owner. Similarly, when the owner withdraws any money from business for his personal expenses, which we call drawings, it is treated as reduction of owner's capital and consequently a reduction in the liabilities of the business. Second important concept is money measurement concept. Money measurement concept is very important concept. It says only those transactions and events in an organization will be recorded in the account books which can be measured in terms of money. The transactions and events which cannot be measured in terms of money or whose monetary valuation is not possible, that cannot be entered into the books of accounts. All such transactions are happenings which cannot be expressed in monetary terms. For example, the appointment of a manager, capabilities of its human resources, or creativity of its research department, or image of the organization among the people do not find any place in the accounting records of the firm. Because of money measurement concept, only those transactions and events can be recorded in the books whose monetary valuation is possible. Whose monetary valuation is not possible, that cannot be recorded. Due to this principle, even if an event is very much important, but its monetary valuation is not possible, then it cannot be recorded. For example, if a owner dies, if a owner of the business dies, the result can be closure of the business can come to end. But since death of the owner cannot be measured in monetary terms, it cannot be recorded in the books of accounts. So only those transactions and events will be recorded whose monetary measurement is possible. Third concept is going concern concept. Going concern concept says the business will go on forever. Business will continue for an indefinite period of time. We maintain accounting records assuming that business will go on forever. Business will never come to an end. Even if we come to know that business is going to be closed after 6 months, then also we will record the transactions assuming that it will continue for a longer period. It will continue for an indefinite period of time. This assumption regarding continuity of business allows us to charge from the revenues of a period only that part of the asset which has been consumed or used to earn that revenue in that period and carry forward the remaining amount to the next years over the estimated life of an asset. Fourth important concept is accounting period concept. Although we assume that business will continue for an indefinite period of time, then also it becomes necessary to determine whether we are earning profit or business is incurring loss. For determining profits earned by the business or losses incurred by the business, we accounting people determine profit or loss after a certain period of time. After every certain period, which is generally 1 year, we compare the expenses and incomes of the business and arrive at either profit or loss figure. When the incomes are greater than expenses, it is profit, and when expenses are greater than incomes, it is loss. But this comparison is made after a certain period of time. It is a given period of time, which we call financial year, and which is generally 1 year. The next concept is cost concept. In accounting, we record transactions and events on the basis of its cost of acquisition. Any property, any asset is recorded on the cost of its acquisition, irrespective of its market price today. For example, if a building has been purchased in rupees 1 crore before 10 years, then and now is its market value today is 2 crore. 10 years before, the business entity has purchased a building in 1 crore and today its market value is 2 crore. Then also it will be recorded at rupees 1 crore in the books of accounts because of cost concept, which says the assets properties will be recorded on the cost of its acquisition. So in the account books, we continue to show assets on its cost, and from the cost we deduct its depreciation. So that's why we used to show cost less depreciation in the balance sheet. Next important concept is dual aspect concept. This is a very important concept of accounting. It says there will be twofold effect of any transactions. If any transaction take place, there will be two side effect. It will affect two accounts. One account is debit and the second is credit. For example, if we purchase machinery, if the business entity purchases a machinery, then machinery comes to business and cash goes out of the business. Then it has affected two accounts. One is machinery and second is cash. So that's why assets are just equal to all liabilities and capital. In accounting equation form, we write it assets equal to liabilities plus capital. This twofold effect of such transaction affects in such a manner the quality of both sides so as to equation is maintained. Next concept is revenue recognition or realization concept. The revenue for a business transaction should be included in the accounting records only when it is realized. Revenue is assumed to be realized when a legal right to receive it arises. It is noteworthy, we cannot wait till it is actually realized, but it is considered realized when a legal right to receive it arises. That is the point of time when goods have been sold or services have been rendered. This can be cleared by taking an example of sales. Being a business entity, I receive sale order from a customer. Then first point is receiving sale order. And the second point will be I will deliver goods to that customer. And at the final stage, that customer will pay the money. So, according to this realization concept, we cannot record this transaction at the event when I received sales order, because sales have not been affected on that date. At the same time, we cannot wait till the customer pays money for the goods delivered. The legal right to receive the payment arises when the goods have been delivered to the customer. When goods have been delivered to the customer, then the legal right to receive the payment arises. Therefore, the accounts transaction of sale will be recorded at the time when goods have been delivered to the customer, not at the time of receiving sales order, neither at the time of receiving actual payment. Instead, it will be recorded at the time when the goods have been delivered to the customer. Thus, credit sales are treated as revenue on the day sales are made and not when money is received from the buyer. Next important concept is matching concept, which says expenses incurred in an accounting period should be matched with revenue during that period. It follows that revenue and expenses incurred to earn these revenue and expenses incurred to earn these revenue must belong to same accounting period. Matching principle says that expenses of a particular period should be matched with revenue of that particular period only. For example, expenses of year 2019-20 cannot be matched with the revenues of financial year 2020-21. It should be matched with the revenue of the same year. The matching concept thus implies that all revenues earned during an accounting year, whether received during that year or not, and all costs incurred whether paid during the year or not, should be taken into account while ascertaining profit or loss. Due to this principle, outstanding expenses are also shown in the profit and loss account. They are added to the concerned accounts, and prepaid expenses are deducted from the concerned head. In the same way, incomes which have been earned but not received till date are also shown as income of that particular year. Next important concept is full disclosure concept. This concept says financial statements are the only or basic means of communicating financial information to all interested parties. It becomes all the more important, therefore, that financial statements make a full, fair, and adequate disclosure of all information which is relevant for making financial decisions. The principle of full disclosure requires that all material and relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statements along with accompanying footnotes. This is to enable the users to make correct assessment about the profitability and financial soundness of the enterprise and help them to take informed decisions. Due to the concept of full disclosure, we also show contingent liabilities as a footnote to the balance sheet because of the requirement of full disclosure concept. Next is consistency concept. A policy, a procedure, a method, once adopted, should not be changed from time to time. Any method adopted once, that should be followed year after year. That should be followed consistently by the business enterprise. It should not be changed unnecessarily. Accounting policies and practices followed by enterprise should be uniform and consistent over the period of time. However, consistency does not prohibit changes in accounting policies. Necessary required changes are fully disclosed by presenting them in the financial statements, indicating their probable effects on the financial results of the business. Next is principle of conservatism or conservatism concept. The concept of conservatism, or also called concept of prudence, provides guidance for recording transactions in the books of accounts and is based on the policy of playing safe. This is based on policy of playing safe. The concept of conservatism requires that profits should not be recorded until realized, but all losses, even those which may have a remote possibility, are to be provided for in the books of accounts. To illustrate, valuing closing stock at cost or market value, whichever is lower, creating provision for doubtful debts, discount on debtors, writing off intangible assets like goodwill, patents, copyrights, etc., from the book of accounts are some of examples of application of principle of conservatism. This principle of conservatism says, provide for all the possible losses, but anticipate no profit. Provide for all the possible losses, but anticipate no profit. For example, we we make provision for bad and doubtful debts on debtors due to possibility of non-recovery. But even if we come to know that one of our creditor have been died and we will not have to make payment in future, then also means after knowing the fact that creditor have died and there is no chances of making payment to that creditor, then also this cannot be recorded. This cannot be reduced till the final accounts. But if there are chances of escaping the payment by any debtor, we will make proper provision in the books of accounts. Lastly is the materiality concept. The effort should not be wasted in recording and presenting facts which are immaterial in the determination of income. The materiality of a fact depends on its nature and the amount involved. Which transaction is material and which is immaterial, it will depend upon two things. One is nature and second is value. Second is amount involved. Any fact would be considered as material if it is reasonably believed that its knowledge would influence the decision of informed user of financial statements. All the information about material facts should be disclosed through the financial statements and the accompanying notes so that users can take informed decisions. In certain cases, when the amount involved is very small, strict adherence to accounting principles is not required. The materiality concept can be cleared by taking an example. For recording business transactions and other uses in the business, we used to purchase pen, pencil, papers, erasers, etc. Pen, pencil, registers, erasers, etc. If we purchase 2 pens today and go to record it in the books of accounts, first of all, we will have to pass a journal entry. After that, we will have to post it into a ledger account, and after that, we will prepare balance sheet. The cost of pen is rupees 10, and the cost of its recording the transaction becomes more than rupees 10. If it is generalized, if it is entered into the ledger, if it is entered into the balance sheet, then cost of recording the transaction should not be more than cost of the transaction. Cost of recording should not be more than cost of transaction itself. If you record pen, pencil, eraser, papers separately, then cost of recording these purchases will be more than cost of pen, pencil, erasers, etc. That's why they are combinedly grouped into one category and we call it stationery. Whether paper has been purchased, whether pen has been purchased, whether eraser has been purchased, whether register has been purchased, all will be entered under the head stationery. This is the concept of materiality. Materiality means only material facts will be recorded. Immaterial things will not be recorded. So these were the accounting principles on which the premises of accounting have been erected. So I am very much thankful to all of you. Thank you very much.